there are two interesting stock battles that I want to do. The first one is Apple. We just had the Apple event. There were some new products launched, which I think nobody was excited for. And we can pitch it against Samsung. And there are two different businesses. I think Apple is fully invested into its own ecosystem. They have the iPhones, they have the iPads, they have MacBooks. They're all really high margin products, and they sell a lot of services to all their users who are on these products. You have Apple Music, you have Apple TV, you have the App Store, and that's where they make most of their money. And I think they will continue building out that entire ecosystem, which could be quite a high margin business. And then if you compare it to Samsung, which is a company that creates smartphones but also creates televisions and displays, they create chips. It's a hugely more diversified business with more scale. There are more Samsung users than there are iPhone users, but their margins are a lot lower. So where should you invest, and how should you look at those two businesses, and how can you compare them? Well, if we look at Apple, what did they do last year? They were up at the beginning of the year. For the full year, they're up 6%. From September 2024 to September 2025. And when we look at a business, we want to look at three aspects. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? Now, as said before, Apple is a high margin business. They have a few products, but their products are doing really well, and they can sell services to their customers for high margins. Samsung is a business that's more diversified. They have more than just smartphones, but their margins are a little bit lower, but they can sell it to more people. So what is the better business? Now, Apple, I think everybody knows what they do. If we look at their AI analysis of their earnings call, we want to see, can they still grow? Is their cash position still good? Can they invest in themselves? And do they invest in themselves at a good rate of return? And are they not? Do they not have too much debt? What do they do with their shares? And do they have a good return on invested capital? Now, let's start out with their cash position. We can go to the balance sheet. We can look at their cash and short-term investments, and it's about 65,000. And we compare that to the short-term debt, which is roughly 21,000. So they have more than 3 times as much cash as they have debt. That's a very good liquidity position. So from a liquidity perspective, they're doing great. If we look at their return on invested capital. Return on invested capital is the money they keep over at the end of the line, at the end of the year, when the business has generated all their money, they paid all their people off, they paid all their factories, they paid for all their supplies, then they can reinvest this money in other businesses or other ventures, and you want a high rate of return on those investments and their capital allocation. Now, 44% is really, really high. I myself aim at 15%. If a company is below that, then it's better for me to get that cash back so I can reinvest it at higher rates of return. But Apple is beating me at 44.3%, so I'm great with seeing that. So their cash position so far is great. Their return on invested capital, or the return on that invested cash, is great as well. And if we look at their margins, like we said, a high margin business. They have 46% gross margins. They have a 30% operating margin and a 23% or almost 24% net margin. And what that basically means is that 24 cents of every dollar they get to keep, that's what they get to reinvest at 44%. And that's the rate, at that rate, they can grow the business. So for an already large business, if we look at their market cap, which is 3.5 trillion, that's quite insane. They still manage to get some good growth. If we look at the revenue growth over the five-year average, they've grown about 10%. Last year, 2%, so that's a decline. They seem to be flatlining. Their cash growth also seems to be flatlining. Yeah, even though last year 10% growth is still quite good. Their return on invested capital has decreased as well. The cash position, liquidity is still good, and they do buy back a lot of shares. So from a business perspective, liquidity is good, low amount of debt, they have a great return on invested capital, they are a high margin business. Only thing is their growth is slowing down a bit. But I think for such a large business, I'm still okay with this. I think their mode is absolutely great. They have a high moat. Everybody knows the iPhone. I think it's very hard for a competitor to come along and outcompete with the iPhone or with the entire Apple product line. So they're quite well positioned for now and the future. I'm still interested what they will do with AI for the future. And I think everybody is still, they call it Apple Intelligence, which is also AI, but they need to have their own name. They can't just call it AI, which I think is a stupid Apple mentality, but let's put that point aside. I would still qualify this as a great business. And we put a question about dividends. They pay a small dividend, about 0.40% compared to the share price, which is quite low. I myself don't really need a dividend if they can get great returns on their invested capital, which they do. How do you find info over dividends? Yeah, you can look up the dividend info here as well. It's all in the software. How would you find the info? Have some passive revenue over the stock price itself. Yeah, I think you're talking about dividends. Dividends are basically a form of passive income over the stock. Usually you would want to see a higher percentage than 0.44. Apple pays a relatively small dividend, so this is not a dividend stock. If you want to talk about how you can find those shares, we can talk about it a little later on, because we have our own stock screener where you can search for companies that do pay a high dividend, and you can buy those and then have a little passive income on your investment. But a dividend is never free money. It always has to come out of the business. And then it's a question of whether or not you want that cash actually to be taken out of the business, or you want that cash to stay in the business where it can generate more returns. And I think Apple is a great case where they can reinvest their capital at such a high rate of return that I wouldn't want them to pay me a dividend, because I'd rather have it that they reinvest it in themselves for the 44% return. And then I will just take the payment when I sell the shares of Apple. But that's to each their own, and it depends on how you want to run your investment and how you want to set up your portfolio. But from a business perspective, I think Apple is still doing great. If we look at the price perspective, I think they're quite expensive. Their price to earnings is 37. That means you pay 37 times what they do in operational earnings. Market average is about 15. You're willing to pay more for a high margin growing business with a strong moat. I think Apple is a business with a strong moat, is a business with strong margins, but they don't show growth, or they show a little bit of growth, but not anything spectacular. So from a valuation perspective, we can actually see if they're overvalued or not by using our price calculator or our value calculator. They basically keep the dividend percent super low to keep punching the stock prices up and to make the investing more attractive. Yeah, exactly. They basically reinvest in the business, they reinvest in themselves, and therefore as a business they can grow quicker, and that will lead to a higher share price. That's the theory. If something happens, I think Apple has a little bit of a China dependency in their whole supply chain. The stock market can still tank, and then dividend is a safer return than stock price. So there's a little bit more risk involved, but that's the gist of it. Now, if we look at the valuation for Apple, they grow, their business record is a 13% growth, and we can use three scenarios, our best scenario, our normal scenario, and our worst case scenario, to kind of predict the current value of Apple if we take their current growth numbers and extrapolate them for the next 10 years. And you always want to pay every investment is the price of the future cash flow. So you want to see where can the future cash flow take this business. I want to pay a price now to get a return in 10 years. And that's how you find value. If the company currently is worth more, according to your valuation, than the stock price, then the company is undervalued, and it could be an interesting buying opportunity. If the value of the company is less than the current stock price, then the company is overvalued, and then it's not looking like a great investment based on your assumptions. Yeah, have a good night. And good luck walking the dogs. Thanks for tuning in. Much appreciated. Let's look at all the scenarios. Best case, let's say they can keep growing at about 15%. I think for a normal case about 10, and worst case, no, I think they can about 12. I think best case will be about 12% growth for 10 years continuing is quite significantly good, especially for a business that's worth 3.5 trillion. Their exit multiple, if they would still grow by 12% for the mode, I would be willing to pay a little bit more. If they're growing less, I would lower the exit multiple, and worst case scenario, I would lower it even more. Now, my desired rate of return is 15 in all cases. And let's see. Yeah, it's currently overpriced according to my scenarios and my calculations. So it's a great business. It's a little bit overpriced. And predictability, I think Apple is quite a predictable business. You know what you're going to get. They're going to release a new iPhone every year. They're going to do a little innovation, but they're mostly going to generate their money based on the services that they sell, which is a high margin business. But they can only grow it as fast as they can grow their own customer base, and I would expect there to be some limit on how much money they can make on their current customer base. Still, from a business perspective, I think it's a great business. I would be willing to pay a little bit more, but I still think it's overpriced, and the growth is just not there to be willing to pay that much money for it. So that's Apple, and I want to compare it to Samsung and see how they differ. Now, Samsung, slightly different. They make smartphones, home appliances, memory chips for consumers and businesses, and their model is built on innovation and technology. They earn money through product sales and services. They have a strong brand, they have a diverse product range. I think that's a big differentiator from Apple. Apple is very focused on their iPhones, their MacBooks, and selling services on those products, whereas Samsung has a way more diverse product range. They're also more focused on businesses, not just consumers. They saw an 11% increase on their DS division. I'm not sure what it is. Due to high-value memory products. This is a durable edge in memory technology. Yeah, they do a lot of memory stuff. They sell a lot of SSDs. I would expect that to fall under the DS division. They show potential for compounding growth in first quarter 2025. They had quite a strong revenue growth due to their Samsung Galaxy S25 sales. They faced a 16% drop, indicating volatility in smartphone sales. Yeah, I think Apple is a little bit more stable there, but Samsung is experiencing some volatility. What are their future expectations? They anticipate a gradual recovery in the second half of 2025, driven by AI and robotics. And I think AI, every company is talking about AI. I always want to see what's behind those words. What are they actually doing with AI? Where are they driving revenue from their AI innovations, or where are they cutting costs? It's very easy to talk about AI, but I want to see the actual numbers backing up their case. They're focusing on high-value memory products and AI-driven offerings. Monitor the performance of the DS division as it drives revenue growth. Yeah, smartphone sales are apparently down. Now, again, we ask the same three questions. Can we get a great business for a great price that we can reliably predict for the future? If we look at their growth rates, their last year growth rates were quite good. Their 5-year average, not too great. From a cash flow growth perspective, last year they had a peak back up, but there was a downward trend. Their return on invested capital is a lot less high than Apple, about 10%. Not too great. Cash to debt position is a lot better, so liquidity is still good. Shares outstanding, they do a little bit of buybacks, but not as much as Apple. If we look at their margins, their net margins is about half of what Apple does. If we look at their market cap, it's in Korean won. It's kind of hard to compare to US dollars. Maybe we can look at their cash flow statement and see what they generate in cash. Yeah, last year it was actually a negative year for them. I want to see some stability here and growth. It's very unstable, and they do about the same Korean wons in cash flow as they did in 2016. So there's not really any growth there. their margins are significantly lower. Their return on invested capital is significantly lower, and this opens you up to more risk. If they get to keep less from each sale they make, their business is more operationally, they require more cash to be able to run. So if you sell less, or if you have less pricing power, if you need to sell for lower prices, there is less maneuverability, and you're vulnerable in a downturn. So it's already looking like a business that's less good than Apple. And I think their sales trend is lower. So from a business perspective, is it looking like a great business? I think their cash flows are unstable. Let's give them the benefit of the doubt. No, I want to say it's a good business. It's not great, it's just good. If we look from a pricing perspective, can we buy it for a great price? If you can buy a good business for a great price, it could still be a great opportunity. But I'd rather buy a great business for a good price than a good business for a great price. Their price to earnings is significantly lower. What did they do over the year? They grew a lot more, about 12%. So if you just look at price, it would be a better investment, but that's not the investment style that we teach here. We want to look at the business that creates a lot more of a safe investing fundament, and that's what you want to take. That's the approach you want to take when you look at the market. You want to buy a better business for a great price, or you want to buy a great business for a great price, and not just go off price of the stock. You want to look at the fundamentals of the business and see if the story is backed up, if there is a good investment case there, and that's where you make your money, not on whether the price is going up or down. Price is not an information point, it's only there for you to take advantage of. Now, if we go back to can we buy it for a great price, the valuation is a lot lower. They pay a higher dividend, their earnings yield is a lot lower, but let's put it into our calculator. Let's say they can grow by 10%, which is above their business record, so it would be best case. Let's say they match their business record revenue growth for normal case, and let's go 3%, then we have an equal division amongst best, normal, and worst case. See how they do. Exit multiple for 10% growth. Let's say we're willing to pay a 10, an 8, and a 6, and we're still looking for 15% return. Let's see if it's over or undervalued. Yeah, this is also significantly overpriced. So we can't buy it for a great price. It's just a good business. And predictability for Samsung, I think, would be a lot lower. I think Apple is a lot easier to predict. They have less product lines. Samsung is more diversified, which could be a protective asset for them. But I think the moat that Apple has in the business that they're in, their smartphone business, their laptops, their MacBooks, I think that's a lot stronger business, a lot more reliable, a lot more predictable than Samsung. Samsung, because they're so they're split across many divisions. It's hard to keep up with each division. Their smartphone sales are up and down. They are not as strong of a margin business as Apple is. So if we pitch Apple versus Samsung, Apple is a better investment, but in my book, Apple is still not the investable company. However, Apple wins based on their brand, their moat, their sticky ecosystem. And if you look at it from a fundamental perspective, they're also the better business, but they're also significantly overpriced. Samsung wins out in their diversifications, and I think they're a bigger manufacturer. They make the chips, which is a huge hype right now. But it's also a little bit cheaper. It's still overvalued, but it's a little bit cheaper. If you want to invest in one of those two businesses, Apple, I think, is the better play for the long term. But always do your own due diligence. Don't just buy something because someone on the internet is saying that it's a great buy. Look at it from your own perspective. See if it fits your style of investing. And if you want to own it, yes or no.